Okay, so let's get started. Welcome everyone to the Footwear Executive Review webinar. My name is Alan Lee. A quick outline of the program today. We're going to cover some industry trends first. Then we'll review a few key performance metrics. We're also going to spotlight a few companies that I think are good examples of the industry trends. Specifically, it's going to be Boot Barn, Foot Locker, and designer brands. Finally, we'll wrap up with some warning signs and our debt metrics. If you have any questions during the program, you can go ahead and submit them. I'll try to address them as we go along. Otherwise, we will have some time at the end for more questions, so don't worry about that. So without further ado, let's get started then. So 2021 really was a bounce back year for the footwear industry as a whole. Sales were up for a number of reasons, but the main ones really were, one, people were returning to shopping in stores. Two, companies raised selling prices, partly due to inflation. And three, there was a bit of a mix of pent-up demand and concerns over supply that combined to create a very high demand environment. And in that environment, companies really were able to reduce their promotional activity to a minimum. Now heading into 2022, well, I guess we're already halfway through, the trends are shifting back in many cases. So while sales are still going to increase this year, we do expect the growth to slow considerably. Now, why is that? A number of factors again. We're lapping the government stimulus that supported spending last year, both the one-time checks, the child tax credits, those kinds of things. And two, retail inflation is hitting highs we haven't seen in decades. Now, the chart on the bottom right shows year-over-year monthly inflation trends, and that for all items, it's still rising. So people are spending a lot more on the necessities, food and gas, and they're having to cut back spending everywhere else. That includes footwear. And for the discretionary spending that is still happening, retail is facing a lot of competition from alternative channels. Think of the experiential channels, things like concerts, sporting events, all those have come back in a big way. And then finally, the full price selling environment from 2021, while it has been strong through 1Q 2022, it's kind of a general consensus now that that is not going to last. If people are tightening their belts, if they're reducing their spending, these companies are going to have to increase their promotions to try to win those dollars. Now, the next trend we're seeing here goes by categories, and is that the pandemic trend towards the comfort, casual footwear has been pretty resilient. Now, this was a kind of trend that was apparent before the pandemic, but really kicked into high gear during it. And some companies have taken advantage of this. For example, Genesco, their Johnston & Murphy banner, they've been shifting to a more casual assortment, and they had 46% sales growth in 1Q. At the same time, Boot Barn, they're now targeting a more casual country lifestyle kind of customer, which we'll go into more detail on later on in the spotlight. Now, on the flip side of that, the dress shoe category, that was one of the ones most directly hit by the pandemic. But the trend we saw in 2021 was a gradual recovery, in line with the return of more formal events, social gatherings, people going back into the offices for work, that kind of thing. Now, DSW, they reported nearly triple-digit growth in men and women's dress in 1Q22. And then Shoe Carnival, they also saw their mix of athletic versus non-athletic products go back to their traditional pre-COVID, 50-50. That was about a 600 basis point shift in 1Q. Now, another trend that we are seeing in footwear is a kind of pullback when it comes to e-commerce. I do want to note that while they are down from the highs, they are still above pre-COVID levels. The chart on the top right here shows e-commerce sales and percentage of total sales for a handful of footwear companies. You can see Famous Footwear went from 22% last year to in 2020 to 14% last year, but that's still above the 10% they had pre-COVID. So what does this mean? Basically, customers are now accustomed to the convenience of e-commerce. They like being able to shop online. That's the new normal for them. What's notable here is that the retailer's e-commerce business is often tied to their brick and mortar store network. All those convenient things that shoppers like, the buy online, pick up in store, BOPIS, same day delivery, buy online, return in store, those all revolve around having that kind of store base to help with that. So the future for this trend really is companies are continuing to spend to develop their omni-channel capabilities. We're seeing things like mobile app integration for in-store shopping. Now everything's integrated, really. One other thing I wanted to note here is that Designer Brands recently acquired the shoes.com domain for $4.9 million. So there's still value in that too. Now, another kind of complementary trend here is that some of the major players are leaning into this direct-to-consumer channel. Obviously, the big names here are Nike and Adidas. This has been going on for a while, but Adidas is now targeting, they want 50% of their sales to come from DTC by fiscal year 25, and Nike is even higher, they're targeting 60%. The chart on the bottom right just shows the percentage of direct-to-consumer sales for the last couple of years for these companies. And then the final trend I want to discuss are the supply chain issues. These got so much attention last year, a little bit less this year, but that doesn't mean that they're not affecting things. They're still affecting things. And they're probably going to keep affecting things through the end of this year into next year. For footwear, there's a lot of bumps in the road that impact the supply chain, from the manufacturing facilities to container shortages and port delays, and just plain old labor shortages. What this means for the industry at its most basic is just higher freight costs. That's going to squeeze their margins for the foreseeable future. We've seen a lot of retailers actually build up their inventories in response to this to try to avoid the out of stocks that a lot of them faced during the holiday season last year. This is a good idea in general, I believe, but it tends to come with its own risks. Basically, if consumer spending weakens, faster than people expect, then these companies could be left with a lot of unsold product. And if they have to mark down that product, that's going to squeeze their margins even further. All right, so let's move into some performance metrics, starting with sales. Now, one thing I should note here is that these are all TTM figures, trailing 12 months figures as of 1Q22. The one exception for that is JD Sports, which is just their fiscal 21 results. They had a bit of a delay in their reporting. So as I mentioned before, sales are up across the board, really. A few notable big increases from JD Sports, that's from several acquisitions. Foot Locker did not have that big an increase, but the reason they're positive is because of acquisitions too. And then Skechers. Skechers had a very big increase. That's due to strong wholesale volumes. I just mentioned that retailers are stocking up inventory, and Skechers benefited from that. Their U.S. wholesale sales were up over 40% compared to retail sales, which were, they're up 16%, but not as high. Designer Brands had a similar trend there, with their wholesale sales lifting retail sales as well. In contrast to sales, the store count, there really hasn't been much uniformity when it comes to store counts. There are some operators that are expanding, others are kind of holding their ground, replacing stores as their leases come up, whereas a few of the other ones are closing stores too. I just mentioned JD Sports. Their increase was due to acquisitions. In the US, they acquired DTLR last February and March. That was about 250 stores. And then the remainder was from Cosmos and MIG, which are European retailers. The decline at Foot Locker here is largely due to their wind down of the Foot Action banner. They closed or rebannered basically all but about 40 locations. And those 40 are expected to be closed or rebannered by the end of this year too. And we'll go into more detail on Foot Locker in the spotlight in a little bit. Genesco closed about 35 stores in 2021, and they expect about 5 net closures this year. So a little bit treading water. One thing to note about them is that they've been testing more of the larger off-mall locations for their Journeys banner. They plan to open about 25 of those this year. Now, for the expanders, the true expanders, we've got Boot Barn, which plans to open 40 stores this year, and we've got Shoe Carnival too. Now, Shoe Carnival for the last couple of years has been closing underperforming stores, but last December they acquired Shoe Station, which was a 21-store chain, and this year they plan to open 10 new stores, followed by 20 in the next year, and then 25 in the year after that. So Shoe Carnival's management, they indicated that they might also do some more acquisitions that would be independent of their organic growth there. So this is a chart of year-to-date comps, so basically just 1Q comps. We have a few in negative territory, Foot Locker, Shoe Carnival. That's mainly just coming off of the significant increases they had last year. So it's the tough comparisons. And, last year's big increases were easy comparisons against the pandemic. Designer brands also had a similar decline, but they're still positive. Again, tough comparisons there. The one company that greatly improved their comps year over year in 1Q22 was Boot Barn. Over 50% growth, over 3.1% increase last year. They've consistently outperformed other footwear retailers recently. Well, that leads me right to their spotlight. So Boot Barn is really an example of a footwear company that's firmly in growth mode. Sales have been strong. We currently have them rated as a B1. The company recently revised its long-term goals now, and they expect the country can support somewhere around like 900 locations compared to the 300 they have at the start of this year. As a result, they're targeting at least 10% annual unit growth going forward, and that includes 40 stores for this year. Of note, this year they plan to enter the Northeast market, stores in New York, New Jersey, Connecticut, and West Virginia. Well, West Virginia's not Northeast, but to them it is. This is the last region of the U.S. where they didn't have a presence, so they'll be a full nationwide retailer after that. Now, a big part of this push from them, this revision, is that the idea that they can broaden their appeal to more than just the traditional Western wear, think Western boots, cowboy hats, that kind of thing, and to traditional workwear. The new customer that they're targeting is this country lifestyle, a younger, more modern customer. Just in 4Q, they launched 4 new private label brands targeting these demographics. Now with this, we've already seen shifts in mix from last year. They're going more towards women's wear away from menswear. Men's merchandise was only about 60% of sales last year compared to 65%. And then apparel's also taken on a little bit more of what they're doing. The boots as a percentage of sales crossed under the 50% mark last year. Now, one thing that bucks the trend for Boot Barn a little bit is their e-commerce sales. In the chart before, their e-commerce sales as a percentage of total sales had already fallen back to about pre-COVID levels, around 15%. Now, it could be that they're, more emphasizing the brick and mortar expansion, but I think it's not in the least bit, at least a little bit tied to the fact that until recently, all their e-commerce sales were being fulfilled from a single DC in Wichita, Kansas. The company only recently began delivering orders from stores, and now they're planning to open a third DC in the Midwest. That's definitely going to help them support their store expansion and e-commerce as well. From a liquidity standpoint, Boot Barn is very solid. Over $170 million in combined cash and revolver availability, and they expect a lot more improvement this year too. At least 17% sales growth, though that's closer to 15 if you exclude an extra week this year, and 5% comp growth. The one negative is that they expect gross margin to fall about 110 basis points, and that's almost entirely due to higher freight costs. And that brings us back to the performance metrics First one here is gross margin. So gross margin was up for nearly all the companies in our coverage. And the biggest factor here was selling prices. I mentioned before, all companies were taking advantage of that, high demand environment to do a lot of full price selling. The only company here that had a decline, a slight decline, like 0.1%, was Skechers. And that's because they ate a lot of the freight cost increases for their wholesale business. Now, as I mentioned previously, this full price selling environment, it's not going to last. For the most part, customers were accepting of these higher prices, back in 4Q last year in the holiday season. You get what you can get, but that really can only go so far. And with inflation continuing to be so high, everything is more expensive. There's only so much that they can take. So pretty much across the board, most footwear companies are expecting gross margin to come down this year. The exact amount varies. I just said Boot Barn expects only like 110 basis points decline, whereas Foot Locker coming up is over 300 basis points. That's what they're predicting right now. Now, SG&A margin was a bit more of a mixed bag. We see some improvements from the leveraging impact of the top line growth, but there have been some drags on SG&A margin too, particularly from labor costs. This is not just the front-facing retail store workers, but also the workers in distribution centers all along the supply chain. This has been an issue for retailers all across all sectors. We see some SG&A margin increases at companies like Foot Locker and Genesco and Shoe Carnival as well. Part of that could be attributable to the acquisitions, costs related to integrating those businesses. But if you combine gross margin and SG&A margin, you get pretty much EBITDA margin. Overall, the gross margin gains outweighed any impact from SG&A margin changes, at least thus far this year. And TTM margin as a whole is up everywhere. One thing I did want to note, that negative EBITDA margin from last year for designer brands, that was because they just had negative EBITDA that period. Of course, they were much harder hit by the pandemic. The dress shoe category was very vulnerable. It took them a lot longer to recover compared to these other retailers. But with sales now recovering, their EBITDA margin's back to a healthier 10%. So now that brings us to our second spotlight company, which is Foot Locker. Like Boot Barn, we've rated them at a B1. Now, Foot Locker is a bit of a good example of about a company that's in a transition. The big ongoing news with them is their shifting relationship with Nike, which wants to do more direct-to-consumer sales. Now, in response to that, Foot Locker is expanding its relationship with other vendors. Notably, they called out Adidas, New Balance, and Crocs. Sales from them increased over 50% in 1Q. Specifically with Adidas, they announced a new kind of relationship where they're targeting over $2 billion in sales by 2025, which would be triple the amount of sales they had with them last year. Now, all that said, Nike is still going to continue to be Foot Locker's biggest partner. They're going to account for about like 60% of their sales this year. That's what they're estimating. It was maybe closer to 65, 70% last year, but 60%, that's a drop. And then even next year, probably still over 50%. So things are shifting, but it takes time to shift. Now, looking at Foot Locker's recent results, nominally their 1Q sales were up 1%, but that was due to incremental contributions from their recent acquisitions. WSS, which is a more of an athletic retailer with about 100 locations in the South, and then Atmos, which is a sneaker and apparel brand based out of Japan. So excluding contributions from those two, their 1Q sales for Foot Locker would have been down about 6%, and comps down about 2%. Now that's global comps. In North America specifically, comps are down a much steeper 12%. That's including drops at regular Foot Locker, Kids Foot Locker, Champs, all of them showed declines. And Foot Locker expects that trend to continue this year. They expect a 4 to 6% sales decline and an 8 to 10% comp decline. And as I mentioned before, they're expecting over 300 basis points decline in gross margin, mostly, again, on the freight cost, increased freight costs. And in the midst of this operating pressure, Foot Locker is also opening a lot of stores, closing a lot of stores. For the stores that are opening, they're planning more of these larger format kind of different stores, shifting away from their traditional, 4,000 square foot mall store model towards more off-mall concepts and the more of these larger WSS and community and power stores. Those can be as large as like 40,000 square feet. But at the same time, they're going to close about 190 stores. That includes the 40 or so Foot Action stores, some of which may be rebannered as opposed to closed. So all in all, Foot Locker remains, they're the big operator. They have substantial liquidity, over $1 billion, and they also still have a net cash position. Even after the acquisitions of Atmos and WSS combined, I think it was about $1.1 billion. They still have a net cash position at the end of the day. So our next performance metric here is CapEx margin. That's capital expenditures as a percentage of total sales. You see a bunch of the retailers here are in the 1 to 2% range. That's, basically just maintenance capital expenditures, remodeling stores as necessary, making necessary improvements, not necessarily a lot of store expansion there. And then on the other hand, you see some in the 4% or higher range, like Shoe Carnival and Boot Barn. That's reflecting their strong store growth. For example, you can see Shoe Carnival last year was only about last year TTM was only about 1.1% because they were just finishing that period of closing underperforming stores. But you see they've quickly flipped back into we want to open stores now, especially under the new Shoe Station banner. So our next metric here is TTM free cash flow over TTM sales. Now, free cash flow indicates financial flexibility. What companies use their free cash flow for varies. Usually comes down to paying down debts or dividends or some other way to invest in the business. The big drops you see for most of the companies here are directly tied to the inventory buildups. We just saw Foot Locker, their inventory was up 38% year over year. And Boot Barn's inventory was up 72% year over year. These companies really want to avoid those difficulties they faced at the end of last year, where some of them were caught without inventory to sell. Really bad situation. At the same time, another factor in play here are the supply chain delays. It's taking longer for inventory to get shipped. So in-transit inventory is up. Also, some companies are receiving inventory late. What good is winter product if you get it by spring or summer? Genesco is an example of this a little bit. They stated in 1Q, they only received 40% of their 1Q inventory by the last month in April, basically. So it's obviously not ideal. So Genesco said that they're going to hold some of that, try to carry it over into the next year. But that's not great. That's stuck on your balance sheet. It's not a great use of working capital. So these are the kinds of issues that the supply chain delays are causing that go beyond just increasing shipping costs. It has effects all down the line. Now, thus far, the TTM free cash flow has been strong enough that most are still in positive territory. So they have not necessarily had to use borrowings to cover increased working capital requirements, anything like that. Skechers and Foot Locker are the only ones, well, Foot Locker barely negative through 1Q. So our third spotlight today is on designer brands. We currently have them rated as a C2. They're a little bit in the middle, not really physically expanding. Their store count was actually down 1.2% year over year, but they are looking to develop their own brands business. Designer Brands has a portfolio of brands and licenses, most notably their Vince Camuto. And a big chunk of their 18% sales growth in 1Q22 was from higher wholesale volumes from these brands. About 25% of their 2021 sales were from owned brands, and they're targeting 33% by 2026. That's considerable progress, but at a little bit slower pace comparing 2020 to 2021. Another thing that kind of makes Designer Brands a little bit unique, I touched on this before, was that they have a heavy mix of dress shoes, fashion categories. Athletic was only about 21% of their sales mix in this last quarter. That made them lag behind other footwear retailers when it came to recovery, just because dress shoes were not necessarily high priority for customers. What they did see in 2021 was a more gradual recovery. You see, the dress category sales were down nearly 60% in 1Q21, but then only down about 19% by 4Q21. And then now in 1Q22, it's come back in a big way. Men's and women's dress up in the triple digits. Now, Designer Brands did not provide guidance on their store plans for this year, so there may be another slight decline this year. But what they are doing is remodeling. They debuted a new warehouse reimagined prototype store just last month. It's a more open format kind of store, and it's supposed to emphasize shop-in-shop concepts, so they can put their own brands in some places, but also national brands. The company definitely has enough liquidity to handle the capex to do more of these remodels should they prove successful. They recently upsized their revolver from $400 million to $550 million actually. And then their leverage is very low. They have about $306 million in debt, but they anticipate receiving a $160 million tax refund, and they're going to use most of those proceeds to pay down that debt. Here's a stock chart showing the year-over-year change in stock prices for the companies in our coverage. It's a sea of red, but the whole market is down, so it's not necessarily surprising. We have Foot Locker and Shoe Carnival at the bottom of the barrel. That's partly probably due to the acquisitions that they recently did. But yeah, down across the board, that's not surprising. So finally, let's move on to some of these debt metrics. We'll start with percentage availability under the credit facility. Now, it's important to note that companies use their revolvers often in different ways. Some don't touch it at all. You see Foot Locker's 100%, 100%. Others use it like cash almost. They always have some amount of borrowings. They don't hold much cash on hand. They just use the revolver. And also, capacities are different. So Foot Locker having full availability under a $600 million revolver is not exactly the same as Shoe Carnival having 99% availability under a $100 million revolver. So it's just things to note when you're looking at this kind of thing. Sometimes it's better to focus on the change year over year. So in that case, you can see Skechers went from 2% availability last year to 91% availability. That's just a result of them fully drawing down their revolver when the pandemic started to get some financial flexibility. A lot of companies did that. But they just repaid it back in 2Q. So a little bit of a timing thing there. It's not like they actually lost availability, just held it as cash on hand. For Designer Brands, they went from 73% to 43%. That's from them using their revolver to pay down the term loan. Now, the reason they did that was just to reduce interest expense because the rate on the term loan was higher than the rate that they would have paid on the revolver. So, them doing that doesn't change their net indebtedness, but it changes something else there. And also, we just mentioned before, they did increase the capacity of their revolver as well. Boot Barn going from 100% to 84%. That's the company tapping that revolver to help build up that inventory. If you recall, their inventory is up 72% year over year, and also to probably support their store expansion. So here we have debt to TTM EBITDA. So for this one and the next one, which is interest coverage, all the footwear companies in our coverage are fairly healthy. For debt to TTM EBITDA, they're below 1 times for all of them. That's well away from our typical warning sign of 3.5 times. Debt levels for some, like Caleres, may have been a little elevated last year and during the early stages of the pandemic, but now that things are normalizing, they've basically returned to pre-pandemic levels. There's plenty of companies that have minimal leverage, like Genesco and Boot Barn, and Shoe Carnival is debt-free. This is partly why some of these companies are more comfortable with restarting, dividends and share repurchases. A lot of them had paused them at the start of the pandemic to preserve liquidity, but now that things are normalizing, they're back to doing it. The option of where to use that cash for paying down what minimal debt you already have versus, doing a shareholder distribution, maybe they see more value in that. So with TTM interest coverage, again, same story. They have minimal debt balances, and interest rates have been low for a long time, so they're all well ahead of our traditional warning sign, which is 3 times. Now interest rates are finally rising a little bit, but likely not enough to put any of these companies anywhere close to our warning threshold. Certainly not anywhere close to financial covenant thresholds. And that brings us to our final slide here, which is credit rating. Given the operating improvements we've seen over the past year, we've upgraded most of the footwear companies in our coverage. For some of them, it's basically getting them back or close to back to where they were before the pandemic. To get further upgrades, we'd have to see more sustained improvement, especially as they're coming against tougher comparisons now. I don't think that's necessarily going to happen given the pressures that they're going to face this year. So for an overall summary, I would say the footwear industry has performed well this past year. It's naturally going to slow down. Exactly how much of an impact inflation is going to have on demand and how promotional these companies are going to have to get remains to be seen. I think a few companies were definitely surprised that the full price selling environment was strong in 1Q, but they all still expect it to fade as we move through the year. We talked a bit about the supply chain issues. They'll continue to pressure margins. So part of the gains that these companies have got over the past year are probably going to have to be given back in that sense. But nevertheless, they all have healthy balance sheets, at least these ones, and solid liquidity to handle any of these short-term bumps in the road. Okay, that's the end of my prepared remarks. If anyone has any questions, feel free to type them in. I'll stick around for a little bit. Otherwise, you can always reach out to me, call or email. That's all that works as well. Okay, I think we're not seeing any here, but that's fine. Again, call or reach out to me at any time, any questions you may have. And thank you for coming. I appreciate it.